Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets.
Kansas City wheat. In early October last year, the market broke down and out of the August to October 2022 bull channel. A choice was now presented to this market for the future. This is a parallel to what we saw in other wheat futures markets. Thus, this market had two avenues. The market chose what I described in my commentaries from some months ago, and I quote, the straightforward move down with potential targets for the break of the bull channel. Thus, we have a primary target X down at 903 zone, whilst the secondary high to reach target X1 is way down in 759 zone. And that's the end of the quote. In late November, prices reached the primary target at 903, but then prices hit the big red trend line that streaks across the market and across my daily chart. Of the neckline of the small but influential October 2021 to January 2022 head and shoulders top, currently 840. And things slowed, even moved up a bit after a small double bottom formed over January. This double bottom saw its rise reach back up to the primary target, but the rise was eroded by resistances until it finally came upon the two combined resistances overhead that it could not overcome. They were the 50% Fibonacci line at 900, and perhaps more importantly, the then declining medium moving average, currently 850. 6 weeks ago, the market gave up pressing higher and dropped, but here comes that red neckline again, slowing and interfering with the decline, along with support from August 22 low at 808 plus congestion at 878 to 791, at 772 and 762 to 765, as well as the 2022 low at 748, and in the periphery the December 2020 to date uptrend, currently at 755. Now, the red neckline had also started to act as a cap on some of the recovery rises, reinforced by the short medium moving average. These resistances were severely tested last week, but with no close over it. However, it did lead to a weekly key reversal up 2 weeks ago that kick-started the move higher again, though the market almost immediately ran into further resistances between 855 and 881, with significant levels at 855, the 2014 high at 856, and the 2013 high at 862, plus the 50% Fibonacci line in September 2019 to May 2022 move at 881, and finally the significant declining medium moving average, currently 850. There's a lot of resistances there. Last week the market tested all these levels and failed at the last one, the 50% Fibonacci line at 881, before collapsing to close lower. All these new resistances may be too much for this market, though likewise I would find it hard to see the market moving down to target X1 at 759. I continue to be in a bit of an indecisive mood over this market. I can see good supports below and I can see good resistances above, probably reinforced with the declining long moving average, plus also the 50% Fibonacci line of the October 2020 to May 2021 move, further higher at 900 even. I will add one further feature which I have highlighted in dark blue on my daily chart, and that's a potential 2023 bear channel, currently 755 to 870. This is very much a presumptive bear channel, and I would easily finesse or even retire it, as needs will, but for now I'd like to leave it there. Overall, much like last week, there seems to be no immediate pattern or path. Perhaps we will just go sideways for a bit, with a question mark added on that last statement. Now, I write this last bit as a bit of a postscript, after moving away, doing some other stuff, and then coming back to this daily chart. I will consider next time whether to draw a pitchfork, a bearish pitchfork, for the mid-February to early April action, but next time, not this time. Minneapolis wheat. In late January, prices punched up and out of the upper bear channel line of the first bear channel constructed between October 2022 and March this year. 6 weeks ago, we received the first glimmer of bearish pressure. Initially, we saw how the medium moving average, currently 896, had capped the market over the week of the 13th to the 17th of February, and then the following Monday, the 21st. we saw the start of a move lower. combined key reversal down and bearish engulfing pattern. Now 5 weeks ago, when by then the market reached down to the broken upper bear channel trend line from above, plus the 2017 high at 868 and the August 2022 low at 862, we saw some hesitation, which became a bear flag over the turn of February into March. This had a potential target down in the 810 zone, and we came so awfully close to reaching it, with prices filling in the old gap, 817 even to 817.5, dating from July 2021, but no more. This gap triggered a reactionary move back up, with prices punching up and out, breaching once more from below this broken bear channel. There was no weekly key reversal here, as we saw in Chicago, but prices pushed up through the August 2022 low at 862 and the 2017 high at 868, the upper bear channel line, and even the declining medium moving average, but failing to close over those last two. This move higher created a potential second, shallower bear channel, dating from early December 2022 and highlighted in dark blue on my daily chart. It is very much a prospective bear channel, but it is good enough to be constructed. The immediate question now is whether the market will stay within it. I'm not too sure, but until a better pattern or idea emerges, then this will be the way forward. The only thing that needs realigning here is to retire target X at 810. It's no longer functional. Now, I write this last bit as a bit of a postscript after coming back to this daily chart. I'll consider next time whether to draw a pitchfork, a bearish pitchfork, for the late February to early April action. But next time, not this time.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.